We have an extremely bizarre day today in the market. If you look right here, the Nasdaq is down 1.25%. The S&P is down 0.3%. The Dow is up 0.7%. So why this major difference? Okay, well, I'm going to show you. Guys, if you're new to the channel, please subscribe because we do 4 or 5 videos a week. Where we go through the markets, the economy, reacting to it. And I'm going to teach you something here. I can't stand the Dow. The Dow is not calculated based on market cap. So a company that has $100 billion market cap versus a $10 billion market cap, they don't weigh the $100 billion one 10 times more. All they care about is what's the price of the company. It's absolutely stupid. But it explains the Dow right now. You look at the Dow, we got some big gainers here. United Health, Salesforce, McDonald's, Boeing, they're up big dollar amounts, which is what drives the Dow being up. Now, look at the Nasdaq, guys. This is the top 15 of the Nasdaq 100. Guys, only one is positive, and it's barely positive. So, but these are all by market cap, which is what drives the Nasdaq and the S&P. Look at how much these things are down. 2%, 0.3, 2%, 2.7, 3.5, 1.7, 1.14, 1.11, all the way down. Pepsi's the only one as of 2:15 p.m. Eastern time that's in the positive, and it's barely in the positive. Barely. Of all these, there's only one that's barely in the negative, and that's Apple. It's a bizarre day today. Now, with that said, we also see companies like this. A company I own shares of, and actually just bought more shares of today, but please don't buy a company just because I or somebody else on the internet owns it. I'm here to teach a process. On our main channel, I'm teaching a process that you can apply to your own investments. Paycom stock is down big. Down 13 bucks. I bought it about 145 a few months ago. It skyrocketed to 200, then is now back down here. It is down 8.5%. This company, I think, will do very poorly if we have a recession, but they have a good balance sheet and they'll weather the storm. Look at this company's all-time high. All-time high, 558 on 11/2 of 21. 2.5 years ago, it was $558. 144 was the low as of today. That's incredible. But look at this company's balance sheet. Let's go to the 8 pillars. Their free cash flow, they only have 1.75 times their free cash flow as debt. That means if they repeat the next 5 years, like they did the last 5 years, in less than 2 years, in 1 year and 9 months, they could pay off all their debt. Good balance sheet companies stand the test of time. They're able to weather the storm. Now, there are things about Paycom I don't like. But I think it's a company that could be around for a while. And I think if you're interested in good balance sheet companies, take a further look. But again, do not buy it because I or anybody else owns it. Even if Warren Buffett owns it, you don't buy it. Another company that I own that is being affected, HPQ. Guys, this company was up 12, 13% just yesterday. Actually, 19%, something absurd like that yesterday. Just goes to show how much I don't care about fluctuations in stock prices. I don't remember what it was up yesterday. But look at this, down 7% suddenly. Okay, this is what happens in the markets. The markets are up and down. We don't know what's going to happen any given day, any given week, any given month, any given year. But if you understand the right process, if you understand that you buy based on fundamentals and you hold and make money based on your handling of your emotions, you're going to do very well in investing. And this market today, this market lately has been very, very weird. Look at this. I mean, this is just so bizarre. And what's been driving the markets lately? A few companies. Because we're seeing say Dell. Look at Dell today. Dell reported yesterday. They beat on earnings and I think they missed on revenue. Down 20%. I guess they're not even an S&P company. I didn't even realize that because they would be the number one loser in the S&P. And right now it's Paycom. But Dell is down 18%. This is the company that the CEO of NVIDIA says this is your go-to computer company. It's a pretty big testament to hear that from the CEO of NVIDIA. Let's see where NVIDIA is. I believe NVIDIA is down, as we saw on the Nasdaq list. Only 2%. But guys, at one point today, I think it was at 1150 or something like that. And it's fallen since then. 264,000% return from the very beginning of when it went public. This is absolutely incredible, guys. This company is absolutely killing it. But you've got to remember, look at companies like Cisco. I want to remind everybody of this. Cisco, let's look at its max chart. Guys, back in March 27th of 2000, 24 years ago, it hit $82 a share. It has never hit that since. Now you might sit there and say, well, yeah, but the business has sucked since then. All right, well, let's go check that out and see. And if you've watched our channel before, you know exactly how this is going to play out. In the trailing 12 months, Cisco has brought in revenue of $55.3 billion and profit of $12 billion. Let's see what it did that year of 2000. Back in 99 and 2000, they did $12.2 and $19 billion in revenue. And then if you look at their profit, guys, $2 billion and 2.67. So their profit's up 6 times, the revenue's up 3 times, and the stock has never hit that level. Why? Overvaluation. If you overpay for a good thing, even though the hype is great, everybody says it's going to be the first trillion-dollar company. 1 trillion. That's what they said. First one. Never got there. Why? Because the bubble burst. Now the company is selling for 15 times free cash flow and 15 times earnings. It's still grown, albeit slowly, but remember, that's what happens. You can't extrapolate NVIDIA and all these companies to the moon and say it's going to happen forever. Look at Tesla. Tesla's all-time high was $4.15 a share. It's now at 170, 175. Even though the business is a lot better, almost double the revenue, a lot more profit. How does that make sense? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. That's very, very paramount to understand. Every investment's the present value of all your future cash flows. And whatever price you pay today is going to affect that return. The more you pay, the less return you have. The less you pay, the more return you have. That's what's key here. Cisco was crushing it here, of course. And guess what? Their revenue still went up, but the stock has gone down. Their profit was up 6 times since 2000. And the stock has never hit its all-time high in 2000. That's so important. By the way, Cisco isn't the only company like that. There's Intel, there's Micron. Well, Micron's now since hit all-time highs, but it didn't for a long time. This is what's important to understand about companies. Microsoft, its high in 2000 was not hit again until 2015, even though the company had way more revenue and way more profit in 2015 than in 2000. I truly believe right now we're in a very bubble-like atmosphere. I think there'll be a significant drawdown in stocks at some point. When? No one has a clue. But I think the next 5 or 10 years are not going to be good for investors. Does that mean you shouldn't buy stocks? No, of course not. You should still buy companies. You still buy stocks that you understand, but most importantly, low-cost ETFs. And here's why. The stock market's value is going to go like this over time. But here's where the price is going to go. It's going to go like this. And your job is to dollar cost average along the way. You're going to overpay, you're going to underpay. And I'm going to repeat this ad nauseum for a long time. Why? Because if you're able to do this, you're going to beat 99% of your friends. You're going to beat all those wealth managers who have all those fancy MBAs that do nothing. But if you want to buy individual stocks, you can do that. But you got to get the right process, apply it to yourself, and then handle the emotions properly. That's the most important part. Peter Lynch says everybody has the brain power to buy stocks. Not everybody has the stomach. I can teach you very easily how to understand the fundamentals. It's not complicated. In fact, if anyone tries to complicate it for you, you need to run away. They're a charlatan. Avoid them. It's not complicated. It's money in, money out. How much do you perceive the future is going to be? And then what do you pay for that today? But everybody is going to misjudge the future. The point is you have that margin of safety that even when you're wrong, you're still able to do well with it. So if you're interested in learning the fundamentals, but more importantly, coupling it with the emotional part of investing, joining our community of like-minded investors, thousands of like-minded investors can help you with your process and your emotions. Click the link below. Check out our trial. It's well worth it. Check it out. It'll make you a better investor, I guarantee you. Thank you very much for your time.